In May, U.S. consumer price inflation hit 8.6%, the highest in 40 years. Some are starting to worry that we might see a repeat of the great inflation of the 1970s that gave rise to massive unemployment and a depressed stock market. Is history about to repeat itself? What are the key lessons from the 1970s? How is the current economic environment different or not from back then? And what does all this mean for your investments? Hi, I'm David Wu, a former Wall Street investment strategist with a 20-year track record of making actionable predictions about major global change. Welcome to The Money Game, where I take on groupthink, propaganda, and conspiracy theories in my critical analysis of markets, economics, and politics. Before we begin, don't forget to hit the subscribe button so that you will be notified when a new video comes out. The 70s is not just about bell bottoms and good music. It is also known as America's lost decade, shaped by the war in Vietnam, Watergate, and of course the collapse of the Bretton Woods international monetary system that led to a sharp fall of the US dollar. Every decade has its own troubles, but the 1970s will be remembered for inflation. Rampant inflation worldwide and inflation that reached double digits in the United States. There were three peaks of inflation in the US. The first was in 1970 when consumer price inflation hit 6%. The next peak came in 1974 when inflation hit 12.3%. The final peak came at the end of the decade at 14.8%. Every peak was higher than the previous one. People tend to associate inflation in the 1970s with two oil crises. The first being the 1973 oil crisis that was the result of OPEC's decision to quadruple the price of oil in retaliation of Western support for Israel in the Yom Kippur War of 1973. The second oil crisis was triggered by the Iranian Revolution that reduced Iran's oil exports in 1979. Even though the price of oil often gets the blame, the reality is that inflation in the 70s was far more broad-based. As you can see on this chart, that plots the so-called core inflation that excludes food and energy. To understand why this was the case, we have to travel back in time to a decade earlier, the 1960s. Inflation was very low in the first half of the 1960s, often less than 1%. However, starting in 1965, inflation started to climb. In the space of just 5 years, inflation rose from just 1% to 6%, a six-fold increase. What happened? Well, wage growth accelerated rapidly during this period, as you can see on this chart. At the same time, productivity growth slowed sharply, as you can see on this chart. The combination of these two developments meant that average labor costs for every unit of economic output produced went up steadily from 1966 to 1970. In other words, the cost of making things became more expensive. This had two effects. One, it reduced the profit margin of American companies. It shrank from 19% to just 11% between 1966 and 1970. Two, companies that did not want to go out of business had no choice but to raise prices. This was the inflation dynamics in the 1970s. High wage growth led to high inflation. But what caused high wage growth in the first place? Well, a tight labor market. In the first half of the 1960s, U.S. unemployment rate declined to below 4% and stayed there for most of the second half of the decade. By the way, many economists and policymakers at the time thought that unemployment rate below 4% was too low, that was going to be causing inflation. Yet, did anybody do anything about it? No. As is often the case, politics got in the way. As late as 1962, the economic report of the president still said that an unemployment rate of 4% is a reasonable and prudent full employment target for stabilization policy. However, when unemployment rate had reached 4% in 1966, the economic team of President Lyndon Johnson convinced themselves that the economy can operate efficiently at even lower unemployment rates. By 1971, inflation was seriously out of the bag, yet the Federal Reserve chairman went so far as to suggest that there was not much monetary policy can do to contain the wage cost pressures. The Fed, of course, raised interest rates, but by the smallest amount as they could possibly get away with. As a result, inflation marched higher and inflation expectation became unhinged. Businesses and workers were persuaded that the Federal Reserve would tolerate higher inflation. So naturally, workers demanded ever higher wages, and businesses demand ever higher prices for whatever they sold. By the time that the oil crisis came around, this inflation psychology had become so ingrained that the oil price shock became self-sustaining. When looking at the consumer price index of the time, you can still see that as headline CPI inflation rose, core CPI inflation follow with a 6-month lag. It was not until Paul Volcker was appointed chairman of the Federal Reserve and started to raise interest rates aggressively, pushing the economy into a sharp recession, that this inflation psychology was finally broken. So what are the key lessons here? The great inflation of the 1970s was the result of a major policy mistake. It is impossible to bring down inflation without bringing down wage growth first. It is impossible to bring down wage growth without a sharp economic slowdown and a boost to the credibility of the central bank's inflation-fighting credentials. So how similar or different is the current inflationary environment to the 1970s? One, just like the 1970s, the high inflation of today is the result of policy mistakes. In particular, fiscal and monetary excesses in 2021. I've argued in previous videos that all that was achieved by Biden's $1.9 trillion fiscal stimulus and by the Fed's continued quantitative easing was to stoke the fire of inflation and to inflate asset bubbles. Two, as much as the rising energy price over the past year is burning a big hole in people's pockets, it is still small compared to what happened during the 1973 oil crisis that saw a 350% increase in oil price. Moreover, nowadays, energy is a much smaller share of the global and US economy than it was back then. Today, it takes just 0.7 barrels of oil to produce $1,000 of real GDP versus 2.3 barrels in 1973, 2/3 less. So even though oil gets all the headlines, we should be careful not to overstate its importance. Three, as in the second half of the 1970s, US unemployment rate is below 4% right now, in fact at 3.6% in the latest reading. As a result, wage growth, which has been accelerating over the past 5 years, is now at 6%, the highest since the late 1960s. Not surprisingly, just like in the late 1960s, unit labor cost has been climbing, reaching the highest level since 1970. Another thing that happened recently, it did not happen in the 70s, is of course, the pandemic might have permanently reduced US labor participation rate, with many people leaving their jobs and not seeking new ones. Data also shows that the pandemic might have reduced the elasticity of labor supply, people's willingness to work. The fact is that even the very low unemployment rate cannot explain the current record high quit rate among US workers. Four, inflation expectations are surging, suggesting a loss of trust in the Fed and in the Biden administration to bring down inflation. This is having a massive impact on the price-setting behavior of companies. The Atlanta Fed has an index that measures the change of prices to goods and services that change infrequently. The fact it is now at a 20-year high suggests greater ability on the part of companies to raise prices, presumably because consumers are already expecting it. There are important similarities between 1970s and today that should make us worry about the risk of stagflation. In addition to continued supply chain disruptions and economic sanctions against Russia, the world is also facing the prospect of the fragmentation of the global trading system as the result of the new Cold War between US and China that could last for decades. We need to be prepared for the possibility that inflation will be higher and more volatile in the years to come. Higher and more volatile inflation will certainly mean that economic cycles will become more volatile. In other words, recessions will become more frequent. Despite the drop of the stock market over the past 3 months, it is far from pricing this not unlikely outcome. You can see this clearly in the cyclically adjusted price-to-earning ratio developed by Robert Shiller. It is still higher than at any time other than at the peak of the dot-com bubble. Shiller's ratio declined for nearly 20 years after peaking in 1965. Let's hope it won't take this long this time. If you got something out of this program, I would appreciate if you would hit like and subscribe to my channel. If you want to learn more about my investment strategy, come visit us at davidwuunbound.com. Thank you for listening.